It feels like every other headline lately has been about Japan's comeback. After decades of stagnation, the numbers are finally looking up. Their GDP got a big revision upward, consumption is recovering, and the markets are cheering. It's the story everyone wants to hear. The sleeping giant is finally waking up. But in the very same week, all this good news was breaking. The government did something that felt off. They abruptly canceled a student exchange program with Africa. Then they quietly tightened the visa rules for foreign entrepreneurs.
Right.
It's like watching a driver with one foot slammed on the accelerator and the other jammed on the brake. On one hand, the economic engine is revving, pushing for growth. On the other, policies are being put in place that seem to be actively closing the doors.
That accelerator and brake image, it's perfect. It really captures the tension.
This isn't just a minor political quirk, it's a deep, fundamental contradiction. And it forces you to ask a very simple question. What is Japan actually trying to do?
Exactly. And what our sources suggest is that this isn't really confusion. It's more like an inevitable collision course, really. Yeah. It's between this unchangeable demographic reality and, well, political resistance.
Okay.
The core issue, that break you were talking about, is Japan hitting this massive, just non-negotiable demographic wall.
Okay, let's dig into this a bit. We've all heard Japan is aging, but we need to define the exact metric. What's the measure economists use to quantify the economic pressure this creates?
Yeah, the key one is the Old Age Dependency Ratio. People call it the OADR. This is the metric that really cuts straight to the economic heart of the problem.
OADR, got it.
It's a pretty simple calculation, actually. You take the total population aged over 65, and you divide that by the working age population. And that's usually defined as people aged 15 to 64.
Oh, okay. So it's basically telling us how many retirees each worker is supporting, more or less.
Exactly right. And when that ratio goes up, it means fewer working age people are supporting more retirees. It's a direct measure of the strain.
And where is Japan on that scale?
Well, back in 2010, it was already pretty high.
Yeah.
You had only about 2.1 workers supporting every person aged 65 and over.
That already sounds challenging.
It is.
Yeah.
But by 2050, the projections are stark. That ratio is expected to fall drastically, potentially getting close to 1-to-1.
Wow, one worker per retiree. That sounds like a crisis point.
It's a huge strain. Think about the fiscal pressure on Social Security, on healthcare systems, the whole labor market, really, this dramatic rise in the OADR. That's the fundamental structural problem that makes even this current economic recovery feel, well, potentially unstable.
Okay, a 1.1 ratio is screaming for massive solutions, like right now. So what about the usual policy tools, things like fertility incentives or immigration? What does the modeling say about how effective those are against this OADR trend?
Yeah, the analysis we looked at shows some pretty hard limits for both, and the results are, frankly, quite sobering. Let's start with fertility policies.
Yeah.
These are found to be highly time-dependent. What that means is, even if Japan somehow managed to launch an incredibly successful, really aggressive pro-birth policies starting today,
Right.
the economic benefit, the point where those newborns actually enter the workforce and start paying taxes significantly, that would take decades to show up.
That's the famous population momentum effect, isn't it? You can start having babies now, but you don't get that economic relief for 20 years or more. And the OADR problem is happening now.
Precisely. The demographic structure, it's just built up so much momentum that any intervention has this huge delay built in. And what's more, given how old Japan's population structure already is, the models show that to truly compensate for the trend, to actually lower the OADR in a meaningful way, that total fertility rate, that's the average number of children per woman, it wouldn't just need to get back to the replacement level of 2.1.
You would need to go higher.
Far higher.
Yeah.
The research basically calls aiming for that kind of level an unrealistic policy objective.
So the policy lever is there in theory, but pulling it hard enough to make a difference requires this massive, immediate cultural shift towards much bigger families, which just isn't, politically or socially plausible.
It's not seen as feasible, no. And crucially, there's no example of a country successfully engineering such a huge intentional increase just through policy alone. You can see this nearby. South Korea, remember, they had their big first basic plan for low fertility and aged society between 2006 and 2010. Poured resources into it.
I can remember hearing about that.
But they just couldn't raise their national TFR significantly. So for Japan, the realistic outlook for fertility measures is that they might might slow the rate of OADR increase a little bit,
Right.
but they absolutely cannot reverse it or provide any real fiscal help in the coming decades.
Okay, so fertility policy is like a very, very slow burn, no immediate relief there. What about the other lever then, migration? That always seems like the more immediate fix, the policy accelerator.
Migration policy is definitely modeled as considerably less time dependent. It's much more responsive to policy settings. You change the visa rules today, you can get working age immigrants, well, relatively quickly.
Right.
And because of that responsiveness, migration does offer, at least theoretically, a greater potential reduction in the OADR compared to fertility policies, certainly in the short to medium term. But, and this is a big but,
Here comes the catch.
here we hit the second brick wall.
Which is the sheer number needed, I'm guessing.
Exactly, the volume. To just sustain Japan's current demographic structure, just to keep the OADR where it was around 2014, would require, and this is a direct quote from the research, unprecedented and ultimately unrealistic volumes of migration over the next few decades.
Unprecedented and unrealistic. So we're not talking about tens of thousands a year.
No. We're talking about needing potentially millions of permanent working-age immigrants over time, not the sort of numbers usually discussed in policy circles, just to stop the ratio from getting worse, just to tread water.
So the inevitable conclusion, just based purely on the demographic math, sounds incredibly stark.
It really is. Because of this powerful population momentum, neither very aggressive fertility policies nor even massive migration policies can noticeably lower that old age dependency ratio or really reverse the aging trend within the next, say, 20 to 30 years.
Wow.
The best they can realistically hope to do is maybe mitigate the speed of the decline. Slow it down a bit.
That structural reality, it just forces a major rethink of strategy, doesn't it? If you simply can't reverse the core demographics with outside population inputs in the time frame needed, what's the pragmatic way forward?
Well, the pragmatic and really the necessary response, according to the modeling, is you have to adapt. You adapt by maximizing the existing internal human capital.
Okay, what does that mean in practice?
It means things like prolonging working lives, effectively raising the retirement age. It means significantly increasing labor force participation, especially among women and older workers who are currently underrepresented. And, critically, improving productivity through technology, through investment across the existing Japanese labor force.
So focus inward.
That seems to be the most realistic path forward for the next couple of decades, at least while this demographic wave is really cresting.
Okay, so demographics define the problem. They set the hard limits on what policy can achieve in the short term. We understand migration can't fix the long-term OADR problem on its own, but that doesn't mean it isn't economically beneficial, right? Let's shift gears from the constraint, the brake, to the potential opportunity, the accelerator. What does high-volume immigration do for the Japanese economy, according to the models?
Right, and this is where we move from those population projections into really sophisticated economic forecasting.
Yeah.
The researchers used a very advanced model. It's called a multi-country dynamic computable general equilibrium overlapping generations model, or OLG for short.
OLG model, right? We hear that term a lot in these kinds of discussions. Can you remind us why that specific framework, OLG, is so valuable for looking at long-term issues involving population changes?
Yeah, the OLG framework is really designed specifically to model intergenerational transfers. It understands that, when a young generation saves, that can benefit the older generation. And when an older generation needs pensions, that puts a burden on the younger generation.
It sees the economy as generations linked together, not just one static blob.
Exactly. It doesn't look at the economy as just one single entity. It sees it as this chain of overlapping cohorts. And this particular model they used is incredibly detailed. It covers 16 different countries and regions.
16?
Yeah, includes major partners like the US and the EU, but also, crucially, developing countries that often serve as migrant suppliers, places like China, the Philippines, Peru. And it models 65 distinct generations of individuals over time.
Okay, that's complex.
It allows them to quantify really precisely how these demographic shifts affect things like global capital flows and what the long-term impact is on national debt and, importantly, on generational welfare.
So what did this really sophisticated OLG model predict? What are the big macroeconomic benefits if Japan were to, hypothetically, push that immigration accelerator hard?
The findings are, well, pretty unequivocally positive across all the major indicators looked at. Immigration clearly promotes the quantitative expansion of the Japanese economy, primarily, as you'd expect, by significantly increasing the size of the labor force.
Makes sense.
The model compared a baseline scenario, which assumed zero net immigration from here on out, against scenarios with different levels of immigration. The key one was a high permanent annual inflow of 150,000 working-age immigrants, starting immediately.
Okay, 150,000 a year permanently. What did that do to Japan's overall output, say, gross national product?
The numbers are quite powerful, mainly because they show how immigration can actually reverse a projected decline. In that no immigration baseline scenario, Japan's GNP is projected to fall quite markedly after 2030. By 2050, it's forecast to be only about 94.56% of what it was back in 2005. That's the expected path of decline. The population just keeps shrinking.
Okay, a shrinking economy. And under the high immigration scenario, that 150,000 inflow.
Under that permanent inflow, the GNP in 2050 is significantly higher. It reaches 97.07% of the 2005 GNP level.
97.07 versus 94.56. That difference, maybe a couple of percentage points, might sound small initially.
It might, but what it actually represents is the effective reversal of that projected post-2030 economic contraction. Immigration basically shifts the whole trajectory away from decline back towards stabilization and potentially sustained expansion.
Now, I noticed you used GNP, gross national product, not GDP. Does that distinction matter here when we're talking about immigration?
Yes, absolutely. It's an important distinction. GNP measures the output produced by a country's residents, no matter where they are physically located. When we talk about permanent immigration, we're talking about adding new permanent residents.
Yeah, right.
These new residents contribute permanently to the nation's output and its capital base, even if they might remit some earnings abroad initially. So GNP is arguably a more accurate measure of the overall economic scale gained from adding people structurally to the population.
Okay, that makes sense. So beyond just total output, high immigration means more working age people, and they tend to be net savers, right? Does this help address that other big structural worry, Japan's rapidly declining national savings rate?
It does, significantly, and that's a major win for the accelerator policy argument. Aging populations typically drag down national savings as older people start spending down their retirement assets.
Standard life cycle effect.
Exactly. The OLG model shows quite clearly that the rejuvenation of the population structure, bringing in younger, working-age immigrants, raises the national savings rate quite dramatically. In fact, the savings rate is notably higher under all the immigration scenarios they tested in every single year modeled.
How much higher?
In the full, permanent, immediate scenario starting back then, the savings ratio in 2010 was already projected to be 14% higher than the no immigration path.
14% higher savings rate. That's substantial. And this injection of working-age savers and taxpayers must directly attack Japan's huge fiscal problems, right? The pension burden, the massive public debt.
Precisely. That's the other major benefit. Substantially increased inflows of working-age immigrants reduce the future need for really difficult fiscal reforms, like cutting benefits or raising taxes drastically.
Because they just expand the tax base immediately.
They expand the tax base, they start contributing to Social Security right away.
Right.
This directly alleviates the pressure on the government's balance sheet.
Can we actually put a number on that fiscal relief? How much does immigration, just on its own, help chip away at that mountain of debt?
Yeah, the model provides a concrete number for that. Under that permanent annual inflow of 150,000 immigrants, the forecast is that the public debt to GDP ratio is reduced by a very significant 19.79 percentage points by 2050, compared to where it would be in the no immigration baseline.
Wow, almost 20 percentage points lower debt to GDP. That's a huge step towards fiscal sustainability. And importantly, it's achieved without cutting any public spending or raising taxes on the existing population.
That's the key attraction, politically.
And presumably that reduction in the future burden translates directly into welfare gains, right? Especially for the younger generations who would otherwise have to shoulder that massive debt and the crushing costs of supporting a much older population.
That really is the most compelling finding from the OLG analysis. It's the true victory, you could say, of the accelerator policy. Immigration policies lead to clear welfare gains measured in terms of lifetime resources for both current and future generations of Japanese citizens.
How?
Primarily by reducing that future burden of public debt and pensions that would otherwise fall heavily on the younger cohorts. And look at the generation born in 2050 specifically.
Okay.
They see a really dramatic welfare increase, estimated at 14.2 percentage points under that permanent high-volume immigration scenario.
A 14.2 percentage point jump in lifetime welfare. That's an incredible number. Why does that specific generation, the one born way out in 2050, benefit so much?
Well, they benefit the most because they are essentially the first generation to live their entire working lives under this new, more stabilized regime. They basically avoid the worst of the fiscal crisis.
Ah, I see.
They inherit the benefits, the rejuvenated tax base, the lower public debt ratio, without having had to pay the absolute highest taxes during the peak crisis period before the reforms fully kicked in. So for them, immigration acts almost like a massive generational relief package. It makes their expected lifetime resources substantially greater.
Okay, this makes the economic argument seem exceptionally strong, almost a no-brainer. Immigration is good for overall growth, it stabilizes savings, it significantly reduces debt, and it provides these huge welfare gains for future generations. How does that stack up against the alternative, which is usually painful, standalone fiscal reform, like, say, just jacking up the consumption tax?
Yeah, the model did explicitly compare the optimal immigration scenario to that kind of alternative, specifically a drastic increase in the consumption tax, acting alone as a fiscal tightening policy.
Yeah.
Well, for example, raising the consumption tax all the way to 30%. That does work in a way. It reduces the debt GDP ratio dramatically by something like 472 percentage points by 2050 compared to the baseline. It achieves fiscal sustainability, all right.
Okay, solves the debt problem, but what's the cost?
The cost is welfare. That aggressive tax hike causes a significant welfare loss for basically every generation born after 1940. Why?
Yeah.
Because the much higher consumption tax simply reduces their lifetime disposable resources.
So it fixes the government's books but makes people poorer over their lifetimes.
Essentially, yes. The tax path improves the government's balance sheet, but it does so at the direct expense of citizens' welfare. So the conclusion from the research is really clear. The optimal policy isn't a standalone tax hike. It's a policy mix.
A combination.
A combination of high immigration and some additional, probably more moderate fiscal reform. But immigration itself is concluded to be, quote, a good policy because it generates those macroeconomic, fiscal, pension, and welfare improvements all at the same time. It offers that political holy grail, solving a huge problem without imposing immediate, visible pain on the current electorate.
Okay, so the economic accelerator is just screaming, immigrate, more people, because it appears to be the most effective and, crucially, the least painful way to manage this structural decline. But this brings us right back to that contradiction we started with. If the economics are so clear, why is the government still tapping the brakes politically and socially? Why are we seeing doors closing, even symbolically, despite these overwhelming findings?
Yes, this is where the pragmatic benefits hit the wall of political reality. This is the political brake shoe kicking in. And it's actually directly linked to that generational conflict we just touched upon.
Oh, so?
Well, precisely because immigration is modeled as being so effective at easing the future pension and debt burden, it becomes a very attractive external mechanism, a way to bypass politically excruciating internal reforms.
It lets politicians avoid the direct fight.
Exactly. It helps avoid that direct, head-on clash between the interests of younger and older generations, especially regarding things like the pension system, where, the basic choice is often framed as, do you reduce benefits for the politically powerful elderly, or do you increase taxes significantly on the already struggling working generation?
And getting political agreement on those kinds of trade-offs, asking a large elderly voting bloc to accept less, or asking working families to pay much more, that's often just seen as too difficult, politically toxic even, for any ruling party.
Precisely. So immigration offers this potential way out.
Yeah.
But in doing so, it creates its own set of political and social resistances. And you see this duality, this conflict playing out right now in the actual policy landscape.
Like the examples we started with.
Exactly. On one hand, you have explicit government goals to promote things like economic partnership agreements, the EPAs, and those are specifically designed to increase the inflow of foreign skilled workers, think nurses, caregivers, vital for elderly assistance.
Right.
And you also have that national strategy aiming to boost the number of foreign students to 300,000, with the stated goal of enhancing international competitiveness and making it easier for those graduates to find jobs and stay in Japan.
Right.
That's clearly the accelerator side pushing for more integration.
But then, the break. The sudden cancellation of that student exchange program, the quiet tightening of visa rules for entrepreneurs, these seem to directly contradict those goals. What are the fundamental non-economic roadblocks that explain this government hesitancy? Why resist the high numbers, that 150,000 plus annually, that the economic models strongly recommend?
There seem to be 4 major non-economic obstacles that really complicate pushing for those high-volume immigration policies.
Okay, what's the first one?
The first is just, well, social tolerance and absorption capacity. This is a fundamental cultural question, really. Can flows of the magnitude we're talking about, remember, 150,000 to 200,000 people every year permanently, can that be socially tolerated, smoothly integrated by the native Japanese population over a long period?
It's not just a temporary labor fix. It's a permanent change to society's fabric.
Exactly. It's a structural change. That's the first big question mark.
And the second obstacle?
Attractiveness. Is the Japanese opportunity actually compelling enough? Can it overcome the significant language barriers, the cultural differences for potential immigrants? Especially when Japan is competing fiercely with other developed nations for the same pool of global talent.
Right.
Remember, the models often assume immigrants come from places like China, the Philippines, Peru. Highly skilled workers from those countries and others, they have choices. And if Japan is perceived as too difficult to integrate into, linguistically or culturally, it might simply lose out in that global talent war, even if the doors are technically open.
So even if the policy says welcome, the practical reality, the lack of easy integration, acts as a kind of cultural brake on attracting the right people in sufficient numbers.
That's a good way to put it.
Yes.
Now, the third obstacle is a really crucial nuance. It actually limits the long-term effectiveness of immigration as purely an economic fix. There's a finding deep within these OLG models that while immigration provides this massive short to medium-term fiscal boon, over the very long run, it can actually lead to fiscal deterioration.
Wait, hang on. If they're working and paying taxes now, how does it cause deterioration later? That seems counterintuitive.
It does initially, but think about the very long term. Eventually, those immigrants who arrived decades earlier, they will retire.
Ah, of course.
And in the long run, these retired immigrants, who the models usually assume adopt the same low, below replacement fertility rates as native Japanese from, well, they will start collecting pensions. They will draw on the Social Security system. Over many decades, they eventually become a net burden on the public pension system, similar to native retirees.
So permanent immigration doesn't eliminate the fundamental problem of an aging population forever. It just kicks the can down the road for a few decades.
It delays and mitigates it significantly for maybe 30, 40 years, but it doesn't solve it permanently on its own. The short-term fix creates its own long-term liability that eventually needs to be addressed, which actually just reinforces the need for those internal adaptation measures we talked about earlier. Higher participation, productivity, longer working lives. Those are still necessary in the long run.
That nuance is absolutely critical. You can see why politicians might hesitate, knowing the huge economic benefit isn't actually permanent, even if it lasts for a generation or two.
Exactly. And finally, the fourth obstacle is more of an ethical and international relations concern, the brain drain issue.
Right.
If Japan becomes heavily reliant on attracting large numbers of skilled workers from developing nations like China, the Philippines, Peru, it raises legitimate concerns about exacerbating the outflow of talent from those countries. That could potentially harm their own development prospects and lead to international friction or resistance. Japan has to navigate these tricky global diplomatic considerations too.
Okay, so we've really mapped out this tension. We have the immense, almost geological pressure of the demographic break. We have the clear, overwhelming economic benefits screaming from the immigration accelerator. But then we find these powerful political and social breaks, tolerance, attractiveness, long-term fiscal worries, brain drain, are still very much engaged. And this leaves the country in a state of considerable fiscal risk, doesn't it? When governments seem unable or unwilling to make these tough choices on demographics or fiscal reform, the financial markets must be watching very closely, particularly the markets dealing with long-term government debt.
Absolutely.
So let's pivot now. How do sophisticated investors, the ones who are keenly aware of these deep, long-term fiscal dynamics, actually operate? How do they use advanced tools to navigate something like the fixed income market in this environment?
Yeah, that's a really necessary transition to make. Because the fixed income market, government bonds, corporate bonds, loans, all forms of credit, it's acutely sensitive to the perceived fiscal health and long-term stability of sovereign debt, especially in a country carrying debt levels like Japan's.
Right.
And investors dealing with these complex instruments, they're increasingly using quantitative tools, specifically machine learning, to try and move beyond just subjective gut feelings about pricing. They want a truer measure of risk and value.
Okay, machine learning. How does that actually help strip the subjectivity out of pricing something like a bond?
Well, it typically employs what are called non-parametric supervised learning models. The goal is to identify mispriced securities, bonds that are either undervalued or overvalued relative to their fundamental risk characteristics.
Compared to traditional methods?
The traditional way of pricing, say, a corporate bond, can be highly subjective. An analyst might compare it to other bonds they personally deem comparable, or they might rely on complex discounted cash flow models, which are notoriously sensitive to the assumptions you plug in.
Right, garbage in, garbage out.
Pretty much.
Yeah.
So the machine learning model tries to act as a more objective pricing mechanism. It aims to calculate what a bond should be worth based purely on its observable features.
And how does it do that? What does it look at?
It's trained on vast amounts of historical data to predict a key return metric. That could be the bond's yield to maturity, or often something called the Z-spread. And it learns to predict this using a range of defined features for each bond.
Like what kind of features?
Things like the bond's official credit rating, the currency it's denominated in, the industry sector of the company that issued it, its remaining years to maturity, and its payment rank. Is it senior debt, subordinated debt, etc.?
Okay, let's pause on the Z-spread for a second. That's a key term for bond investors. Can you break down what that represents in simple terms?
Sure. The Z-spread, or zero volatility spread, is essentially the constant extra yield, measured in basis points or hundredths of a percent,
Okay.
that you'd need to add to the entire yield curve of risk-free government bonds, like U.S. Treasuries, to make the theoretical discounted price of all the bonds' cash flows exactly match its current market price.
Okay, still a bit technical. Simpler.
Simpler terms. It represents the extra return, the risk premium, and investors demanding over the risk-free rate to compensate them for holding that specific bond. It captures the issuer's credit risk, liquidity risk, and other factors all rolled into one spread number.
Got it. Extra yield for the extra risk.
Yeah.
So once the machine learning model predicts what the fair Z-spread should be for a bond based on its features, how does an investor use that information to make a trade?
It's pretty straightforward relative value. If the actual Z-spread you can get in the market for a particular bond is significantly higher than what the machine learning model predicted as fair, the model's basically saying that bond is likely undervalued for its risk profile. You're getting paid more spread, more return than its features suggest you should. So the investor might buy that bond.
Getting more return for the same level of risk, essentially.
Exactly. And conversely, if the market spread is much lower than the model's prediction, the bond is flagged as potentially overvalued. Maybe you'd avoid it, or even consider shorting it if you're able.
Okay. And which specific machine learning approaches turned out to be the most effective for this kind of fixed income prediction?
The research we looked at consistently found that ensemble methods tended to perform best.
Ensemble methods, like a group approach.
Yeah, think of it like getting opinions from a large committee of slightly different experts and then averaging their views. Each individual model in the ensemble is like one expert. By combining them, you tend to get a more robust, less biased estimate. Specifically, a model called the random forest regressor often outperforms simpler strategies like lasso regression or support vector machines or FCR when it came to accurately predicting the bond yield or the Z-spread.
Random forest. Okay. And how accurate were these predictions? In fixed income, even small errors, a few basis points, can matter a lot.
They absolutely do. And the performance reported was actually extremely high for this kind of task. The models achieved a mean absolute error, or MAE, of around 35 basis points when predicting the yield, and slightly better, about 32 basis points when predicting the Z-spread.
32, 35 basis points MAE. How good is that in context?
Given the typically tight margins and the sheer volume traded in institutional fixed income markets, an MAE that low is really impressive. It suggests the model is successfully filtering out a lot of the market noise and subjective bias, allowing investors to systematically identify securities, offering better relative value, and potentially exploit those small transient mispricings.
Okay, so that's really focused on picking individual securities, the bottom-up approach to investing. But given all the volatility we've discussed, driven by these huge demographic shifts and policy uncertainty, portfolio managers also need that top-down view, right? They need to know how to allocate capital between different asset classes globally, especially when the relationships, the correlations between markets seem to be shifting so dramatically.
That's exactly right. And that requires moving to an even more advanced quantitative framework. One approach highlighted is called directional change and directional forecasting, or DCDF.
It's DF.
This really shifts the analysis away from just selecting individual securities to thinking about dynamic asset allocation across the whole portfolio. And the strategic value here is immense. It focuses on trying to forecast the future direction of the rolling correlation between major asset classes.
Like stocks versus bonds versus commodities.
Precisely. For example, forecasting how the correlation between something like the S&P 500 equity index, a broad U.S. corporate bond index, and maybe the DCM commodity index is likely to change in the near future.
And why is accurately forecasting that correlation itself so critically important for building and managing a portfolio?
Well, think about traditional portfolio optimization methods, like the standard Markowitz model everyone learns about. They rely heavily on historical correlations between assets to figure out the optimal mix for diversification.
Right, assuming the past predicts the future.
Exactly. They often implicitly assume those historical correlations will stay relatively constant going forward. But that assumption can fail, sometimes spectacularly, during periods of market stress, regime change, like, say, a major demographic shock hitting an economy or a sovereign debt crisis brewing. Correlations can suddenly spike or collapse.
When everything starts moving together, diversification disappears just when you need it most.
That's the danger. So if you can accurately forecast whether the correlation between, say, equities and bonds is about to change significantly, maybe they're about to start moving much more closely together, or maybe they're about to diverge sharply, you can adjust your portfolio weights dynamically.
Yeah.
You can manage risk much more proactively than relying on simple historical averages allows.
Okay, so it's about predicting the moments when your diversification is about to either fail or maybe even become stronger. How does this DCDF framework actually work to predict those correlation movements?
It's a two-step process, broadly. First, directional change algorithms are used to identify significant shifts, or what they call pivotal points, in the underlying trend of a time series, in this case, the rolling correlation itself. It defines the moments when the market dynamics seem to be fundamentally changing.
Okay, identifies the turning points.
Then, directional forecasting models try to predict the future direction of that metric. Will the correlation go up, down, or stay roughly sideways following that pivotal point? When you apply this to rolling correlation, the goal is to predict these upcoming shifts so that you can potentially rerun your portfolio optimization using the forecasted correlation, not just the historical one.
Allowing you to adjust asset weights continuously based on where you think correlations are headed.
Exactly. To maximize your risk-adjusted returns based on a forward-looking view of market relationships.
Very interesting. So which specific models performed best in the research when it came to actually forecasting the direction of these rolling correlation changes among those key asset classes, stocks, bonds, commodities?
In the application studied, the support vector regressor, the SVR model we mentioned earlier, that one was found to be the most accurate, specifically for forecasting the direction of correlation change. It achieved a reported predictive accuracy of 76.6%.
76.6% accuracy on predicting the direction. That sounds pretty high for market forecast.
It is very high, yes. The SVR model also achieved a strong technical measure called the area under the curve, or AUC, metric of 0.79, which again points to robust predictive power for directionality, something notoriously difficult to get right in financial markets.
That kind of accuracy is definitely compelling. But, in quantitative finance, there's often this temptation, this push to use the absolute most complex bleeding edge models available. Did the research find any benefit here from layering on even more complexity using those really intricate algorithms?
That's a great question. And interestingly, the study found that more complexity didn't necessarily guarantee better prediction in this case. They actually experimented with some highly complex composite algorithms, things that integrated other sophisticated techniques like hidden Markov model or cumulative sum filters to try and generate better predictive signals. But the finding was that while the standard SCR and random forest models performed well on their own, these more complex multi-stage directional forecasting algorithms like combining SVR with an HMM, they didn't really yield significant additional accuracy benefits in this specific financial application.
So simpler was better, or at least just as good?
The takeaway seemed to be that simpler but well-applied directional forecasting algorithms like SVR could achieve high, potentially even superior accuracy levels compared to much more complex setups. It offers a really critical lesson, I think, in financial modeling. Sometimes efficiency and robustness win out over sheer black box complexity.
Okay, so we have really come full circle here, haven't we? We moved from the immense, slow-moving, almost geological pressure of Japan's demographics through the screaming economic benefits of hitting the immigration accelerator, Then the political and social breaks that seem to stop it from really happening. And finally, down to the level of high-speed quantitative tools that sophisticated investors are using to monitor and trade these very pressures, often on a daily or even hourly basis.
Yes, exactly. And the synthesis, when you put it all together, it really reveals that central policy contradiction starkly. Japan is facing these fundamental structural demographic forces that, according to the economic models, demand an immediate, massive, and permanent population adjustment, primarily through immigration, just to guarantee future welfare, especially for its younger generations.
The economic math says this is the optimal path to avoid serious generational welfare loss down the line.
The models confirm that, yes. But then you have the political reality, which introduces these restrictive, breaking policies based on very real domestic concerns about social tolerance, about cultural fit, and also, as we discussed, those justifiable fears about the long-term physical burdens once the immigrants themselves start retiring decades from now.
So the friction between that economic accelerator and the political social break is just immense. It feels almost paralyzing.
The contradiction is palpable. And it's partly because it involves two completely different, almost incompatible timescales. On one hand, you have the immutable pressure of population momentum. That requires decades-long, unwavering political will, a speed of change that's almost tectonic, geological. Meanwhile, on the other hand, you have the global financial markets. Using these high-speed quantitative models, random forests, SVRs, DCDF frameworks, which have to be continuously retrained, often daily or weekly, just to keep up with data drift and transient market shifts. They're making continuous fractional adjustments to pricing and portfolio allocations based on the latest signals.
Two utterly different speeds.
Completely different speeds. And so the true challenge for Japan, it seems, isn't really the economic calculation. They have the data. The models, like the OLG framework, they point towards the optimal policy mix. The real question, the provocative thought perhaps, is whether Japan's governance system can actually develop the kind of multi-generational policy commitment, the sheer long-term consistency needed to match the slow, inevitable speed of demographic change. Because that speed is utterly foreign to the daily high-frequency adjustments and reactions of the global market that watches its every move.